the invisible rulers of money. You don't vote for them. You don't see their faces on campaign posters. Yet, they own the walls around you, the company you work for, and the data that defines who you are. They don't build things. They don't invent things. They move money, and somehow that gives them more power than the people who write laws. Because in modern America, money doesn't just talk. It governs. Welcome to the Financial Historian, where money, power, and history collide, and where every story reveals that nothing in our economy is ever as simple as it looks. Most people have heard the term hedge fund. It sounds harmless enough, something between a legal loophole and a lawn care business. But behind that odd name lies one of the most powerful inventions in modern finance. A hedge fund, at its core, is a private investment club for the ultra-wealthy. A place where billionaires, pension funds, and giant corporations pool their money and hand it to a small group of financial wizards with one mission: make as much profit as possible using any method the law allows. Unlike mutual funds, which regular people can invest in through their banks, hedge funds have almost no rules. Mutual funds must play safe. They have to report their holdings, limit their risks, and operate transparently. A hedge fund plays by a different rulebook. Or rather, it writes its own. It borrows heavily to multiply its bets, trades complex financial contracts called derivatives, and can even profit when markets crash. The birth of an idea. The first hedge fund wasn't built on greed. It was born from caution. In 1949, a quiet sociologist named Alfred Winslow Jones wanted to find a way to invest without being destroyed by market swings. His idea was simple but revolutionary. Buy some stocks he believed would go up, and simultaneously bet against others he thought would fall. This was the birth of hedging. But betting against a company's stock is not like buying one. You can't just sell something you don't own. So Jones used a method called short selling. Here's how it works. You borrow a share from your broker, say it's worth $100, and immediately sell it for that same $100. If the price later falls to $60, you buy it back cheaper, return it to the broker, and keep the $40 difference as profit. But if the stock rises instead, you still have to buy it back, maybe now for $120, meaning you lose $20. And since the stock's price can rise infinitely, your potential loss is unlimited. Jones didn't invent short selling, but he perfected the art of using it to reduce risk, not chase danger. His fund balanced long and short positions so that no matter which way the market moved, his portfolio stayed relatively stable. It was cautious, clever, and deeply mathematical. But like many good ideas in finance, it wouldn't stay humble for long. The evolution of risk. By the 1980s, America had changed. Ronald Reagan's government was rolling back regulations. The Federal Reserve was taming inflation. And the financial world was awash with cheap debt. For hedge funds, this was gasoline poured onto a spark. These funds weren't banks, so they didn't need banking licenses. They weren't public companies, so they didn't have to disclose what they did. They operated in the shadows, invisible to most regulators but connected to nearly every major market. If the average investor is playing chess, hedge funds are playing poker with borrowed chips behind closed doors at a table the public doesn't even know exists. During this era, the hedge fund industry exploded. Small operations became global powerhouses. They didn't just trade stocks anymore, they traded currencies, bonds, oil, and even countries. And then came the moment that revealed their true power. In 1992, a fund called Quantum, led by billionaire George Soros, made a bold bet that the British pound was overvalued. He bet billions that it would fall, and when it did, he made over $1 billion in a single week. The Bank of England, one of the most powerful financial institutions in the world, lost. One man with a hedge fund had moved a national currency. That wasn't a trade, it was a declaration. Hedge funds were no longer just market participants. They were market shapers. The rise of the super funds. The 1990s brought another kind of monster, long-term capital management, or LTCM. It was the ultimate hedge fund, created by Nobel Prize-winning economists who believed they could use math to eliminate risk entirely. Their models said crises were statistically impossible. But in 1998, reality disagreed. When Russia defaulted on its debt, LTCM's complex bets began to collapse. Within weeks, their losses were so huge they threatened to bring down the global financial system. The Federal Reserve, America's central bank, had to step in and organize a private bailout worth $3.6 billion to stop a global meltdown. That was the day hedge funds learned something new about capitalism. If you're big enough, you don't fail, you get rescued. Risk was no longer something to avoid. It was something to price, manage, and even exploit. From that point on, hedge funds stopped simply playing the markets. They began engineering them. They realized that the same influence that could move a currency could also shape government policies, interest rates, and even corporate behavior. The age of quiet speculation had ended. The age of financial empires had begun. The mechanics of power. Hedge funds thrive on leverage, the ability to control massive sums of money using very little of their own. Imagine you have $1 million. A normal investor buys $1 million in stocks. A hedge fund uses that $1 million as collateral to borrow $9 million more, and suddenly controls $10 million in assets. If the market rises 10%, they double their money. If it falls 10%, they lose everything. That's the core of the hedge fund model: high risk, high speed, high reward. And they grew, they became too important to ignore, yet too complex to fully understand. By the early 2000s, hedge funds were managing trillions of dollars. They employed former politicians, lobbied for laws that benefited their strategies, and financed both sides of political campaigns. They had become the quiet sovereigns of global capitalism, a network of private empires controlling the flow of money, data, and risk across borders. But power has a price, and in 2008, the bill came due: hedge funds and the new financial empire. By 2008, America's financial system was on the edge. The housing market, fueled by cheap credit and endless speculation, had grown into a colossal bubble. Millions of homeowners believed their houses were ever-appreciating assets. Banks and lenders, confident in ever-rising prices, created complex mortgage-backed securities that promised returns too good to resist. And lurking in the shadows, hedge funds were quietly placing bets that the entire system could fail and profit from it. One hedge fund manager, John Paulson, saw the coming disaster long before most economists. But he didn't just issue warnings. He designed financial instruments, credit default swaps, that would pay off when mortgages defaulted. When the housing market finally collapsed, Paulson's funds earned $20 billion, while millions of ordinary Americans lost their homes, jobs, and life savings. This was the paradox of modern finance. Those who understood the system best could turn catastrophe into unimaginable wealth. And the lesson was clear: hedge funds were no longer mere players in the market. They were architects of risk, shaping the economy without ever touching a physical product. Hedge funds as landlords. As the dust settled after 2008, traditional banks faced tighter regulations. The Dodd-Frank Act and other reforms aimed to prevent another meltdown. Hedge funds, however, being private and largely unregulated, found themselves with a golden opportunity. They began purchasing foreclosed homes by the thousands. Entire neighborhoods were transformed into investment portfolios. One fund could own hundreds or even thousands of single-family homes, turning them into rental units managed not by humans but by algorithms. For ordinary renters, this meant the landlord wasn't a person anymore. Rent increases, eviction notices, and maintenance schedules were decided by spreadsheets and centralized computers in New York or London. The relationship between tenant and landlord became a cold, impersonal transaction, a reflection of the broader influence hedge funds had over daily life. By the 2020s, some cities saw 1 in 5 rental homes owned by institutional investors. These investors didn't just own property, they controlled the cost of living, neighborhood demographics, and local economies. Their influence extended quietly but profoundly, shaping communities without anyone ever casting a vote. The shadow banking system. Hedge funds didn't stop at property. They moved aggressively into private credit, lending directly to companies, financing leveraged buyouts, and even providing funds to struggling governments. This network of private lenders became known as the shadow banking system. Imagine your local bank denies a loan. A hedge fund steps in, offering the funds at higher interest but without the bureaucracy. If the borrower defaults, the fund often takes partial ownership. In essence, hedge funds became banks without the name, licenses, or oversight, operating in a parallel financial universe. By 2024, private credit managed by hedge funds and private equity firms exceeded $2 trillion, roughly the size of Italy's entire economy. They had essentially created a hidden financial layer, one that could lend, collect, and control markets without public scrutiny. Leveraging political influence. Money alone didn't make hedge funds powerful. Influence did. Hedge funds became political actors, donating millions to both major parties, hiring former government officials, and lobbying for laws that favored their strategies. This revolving door, where regulators eventually joined the firms they once oversaw, ensured that financial regulations were designed to stabilize the powerful rather than constrain them. Executives from hedge funds sat on advisory councils, attended private retreats with lawmakers, and maintained direct lines to central banks. Decisions about interest rates, bailouts, and emergency lending were no longer abstract policy debates. They were conversations influenced by people who also controlled billions in private capital. Speculation as profit. Hedge funds thrived on volatility. When markets were calm, they earned steady returns through leverage and derivatives. When crises hit, they could bet against the world and profit even more. Consider derivatives. Financial contracts that allow investors to bet on the future prices of assets without owning them. From weather to interest rates to natural disasters, derivatives became markets in their own right. Some hedge funds now sell catastrophe bonds, instruments that pay investors high returns as long as major disasters don't occur. If disaster strikes, the money goes to pay for damages. In other words, they literally monetize risk itself, turning human misfortune into revenue streams. Data, surveillance, and predictive power. Hedge funds have also evolved into data empires. They buy satellite imagery to monitor oil shipments, use thermal sensors to track factory activity, and analyze credit card data to predict consumer behavior. Algorithms trained on millions of points can anticipate spending patterns, voting trends, and even corporate movements. Traditional finance reacts to past data. Hedge funds predict the future, not through clairvoyance, but through advanced computation and information asymmetry. Some analysts call them the intelligence agencies of capitalism, quietly observing and exploiting the world in real time. This ability to know and react before everyone else gives hedge funds structural power. When they control critical slices of housing, energy, or debt markets, they don't need to make threats. Their very existence ensures that policies and regulations bend in ways favorable to them. The feedback loop. The most unsettling aspect of this financial ecosystem is that ordinary investors unknowingly fund it. Pension funds, university endowments, and charitable foundations invest in hedge funds for higher returns. Teachers, nurses, and city workers, the very people whose livelihoods depend on these pensions, are indirectly financing hedge funds that manipulate housing prices, commodities, and financial policies. Public money feeds private power, and that power shapes the world in ways most people never see. The illusion of villainy. Hedge funds don't see themselves as evil. They often present themselves as realists, claiming they provide liquidity, efficiency, and innovation. In some ways, they do. They spot inefficiencies, allocate capital quickly, and expose weak business practices. But their success is built on a broader truth of history. Power concentrates until it destabilizes the system. Empires rise not because they create wealth, but because they accumulate influence over critical systems. From the merchant guilds of Renaissance Venice to the East India Company ruling colonies, history is filled with private entities growing more powerful than governments. Today, hedge funds occupy that space. They don't raise flags, armies, or declare wars. They control liquidity, debt, and data, the modern instruments of sovereignty. Quiet control. Hedge funds don't need to overthrow government. They control markets, own assets, and influence policies in ways that are legally opaque but structurally absolute. They profit in both stability and chaos, navigating crises while ordinary citizens face the consequences. Whether it's the pandemic of 2020, inflation spikes in 2022, or the housing collapse of 2008, hedge funds consistently turn disruption into profit, reshaping economies without public scrutiny. And the more essential they become, the less anyone dares to regulate them. If they disappeared tomorrow, markets would seize, credit would freeze, and governments would scramble. Their power is embedded, invisible, and absolute. The quiet empire of capital. By the mid-2020s, hedge funds had transformed from private clubs for the wealthy into invisible empires controlling not just money, but information, infrastructure, and daily life itself. Their influence wasn't always visible. You wouldn't see their logos on the corner of your street or their names on the ballot. Yet their decisions affected how much you pay for rent, the cost of food, and even the stability of currencies around the world. Hedge funds have become the ultimate arbiters of modern capitalism. They don't conquer land or build armies. Instead, they conquer liquidity, debt, and data. And in doing so, they've redefined power itself. Data as the new sovereignty. Information is power. Hedge funds understood this long before the public did. They purchased satellite imagery to track commodities in real time, analyze shipping routes, and use thermal data to monitor industrial output. Credit card transactions, consumer behavior, and even social media trends become predictive signals, feeding algorithms that anticipate market moves before anyone else can react. This isn't just trading, it's preemptive control. If you think of traditional finance as reading last quarter's report, hedge funds operate like seeing the future, acting on patterns before they manifest. They can anticipate economic shifts, policy changes, and market reactions with near-omniscient precision. Some analysts have even called them the intelligence agencies of capitalism. They don't need armies or governments. They only need to know what governments and markets will do a few moments before everyone else. Structural power and invisible levers. The true genius of hedge funds lies in their structural power. They don't need to threaten anyone to enforce their will. When they own significant portions of housing, corporate debt, or critical commodities, their existence becomes leverage. Policies, regulations, and public discourse adjust to accommodate their influence, often without the public realizing it. If lawmakers try to impose strict rent controls, capital can flee to other markets. Overregulate derivatives, and liquidity dries up instantly. Punish speculative activity, and pension funds, which hold billions in hedge funds, suffer. Every layer of the system is interconnected, ensuring that money continues to move even if ordinary citizens bear the cost. The irony is stark. Your own retirement savings, meant to secure your future, are part of the very mechanisms that increase housing prices, commodity costs, and market volatility. This is the hidden loop of modern finance: public money feeding private power, political influence, and the revolving door. Hedge funds have also mastered politics. They donate to campaigns, hire former regulators, and maintain direct lines to central bankers. The so-called revolving door ensures that the people who once wrote the rules eventually work for those who profit from them. A regulator retires, joins a hedge fund, and begins lobbying the same institution they once oversaw. The system self-reinforces. New laws are rarely designed to constrain power. They are designed to stabilize it, often subtly ensuring that hedge funds remain central to market operations. This combination of money, influence, and foresight makes them essential yet invisible pillars of the modern economy. Profiting from stability and chaos. Hedge funds can profit in almost any scenario. When markets are calm, they earn steady returns through leveraged positions. When crises hit, they bet against the system and profit from its unraveling. This duality allows them to financialize disasters. Derivatives, catastrophe bonds, and other instruments turn future uncertainties into predictable revenue streams. From hurricanes to interest rate spikes to pandemic-driven market swings, hedge funds can profit from nearly any outcome. The 2020 pandemic is a perfect example. As global markets tumbled, hedge funds made billions by shorting equities. Weeks later, as the recovery began, they profited again by buying back positions. When inflation surged in 2022, they pivoted into commodities: wheat, oil, metals, profiting from scarcity while households faced rising prices. They don't just bet on outcomes, they influence them. A hedge fund placing a massive position can move markets, shift prices, and even trigger policy responses. Central banks, governments, and corporations pay attention because the consequences of ignoring them are too high. The modern empire. Hedge funds today resemble the great trading companies of history. Just as the East India Company once controlled trade, armies, and colonies, modern hedge funds control liquidity, credit, and data. They don't raise flags. They raise margins. They don't declare wars. They fund both sides. They don't conquer nations. They buy their debt. This is the quiet control of modern America. While politicians debate ideology, hedge funds profit from every headline, every policy change, every shift in sentiment. Markets move, policies adjust, and the funds grow more powerful. Reflections on power. History teaches a crucial lesson. The concentration of power inevitably leads to tension and instability. Empires collapse not because they run out of money, but because they lose balance. The merchant guilds of Venice, the East India Company, and the early financial dynasties of Europe all illustrate this pattern. Hedge funds are the 21st century equivalent. Their empire is built not on physical assets, armies, or conquest, but on leverage, information, and legal architecture. They shape economies, influence governments, and determine the outcomes of crises before most people even know they exist. Yet, unlike historical empires, their methods are largely invisible. They operate in spreadsheets, algorithms, and private agreements. They move money faster than law can react. And because they are deeply embedded, removing them from the system would cause markets to seize, credit to freeze, and governments to panic. The human element. The final irony is that hedge funds don't rely on public consent. They rely on participation. Teachers, nurses, city workers, and retirees, through pensions and endowments, fund the very entities that shape their financial reality. Ordinary people unknowingly enable the system that profits from scarcity, volatility, and crisis. Hedge funds often see themselves as realists, not villains. They provide liquidity, efficiency, and sometimes innovation. But their success depends on exploiting the inherent concentration of power, and history shows that any empire built on leverage and influence eventually faces limits. The future remains uncertain. Will hedge funds continue to dominate unchecked, or will a new financial paradigm emerge? Will technology, regulation, or crisis challenge their empire? What is certain is this: they have reshaped capitalism into something far more powerful and far less visible than most people realize. Reflections on power. History teaches a crucial lesson. The concentration of power inevitably leads to tension and instability. Empires collapse not because they run out of money, but because they lose balance. The merchant guilds of Venice, the East India Company, and the early financial dynasties of Europe all illustrate this pattern. Hedge funds are the 21st century equivalent. Their empire is built not on physical assets, armies, or conquest, but on leverage, information, and legal architecture. They shape economies, influence governments, and determine the outcomes of crises before most people even know they exist. Yet, unlike historical empires, their methods are largely invisible. They operate in spreadsheets, algorithms, and private agreements. They move money faster than law can react. And because they are deeply embedded, removing them from the system would cause markets to seize, credit to freeze, and governments to panic. The human element. The final irony is that hedge funds don't rely on public consent. They rely on participation. Teachers, nurses, city workers, and retirees, through pensions and endowments, fund the very entities that shape their financial reality. Ordinary people unknowingly enable the system that profits from scarcity, volatility, and crisis. Hedge funds often see themselves as realists, not villains. They provide liquidity, efficiency, and sometimes innovation. But their success depends on exploiting the inherent concentration of power, and history shows that any empire built on leverage and influence eventually faces limits. The future remains uncertain. Will hedge funds continue to dominate unchecked, or will a new financial paradigm emerge? Will technology, regulation, or crisis challenge their empire? What is certain is this: they have reshaped capitalism into something far more powerful and far less visible than most people realize. So more videos, like and subscribe.